Happy Friday. As markets continue to be volatile, I want to take a couple of minutes and talk through a couple of things that we're seeing. And I want to ask you for 4 minutes to go over 4 charts that we think are really important in today's world. Number one, we're getting into the end of week 4 with the conflict in Iran. I know it's got a lot of people on edge and nervous, not just about our investment portfolios and the economy, but about a lot of other things that are going on in the world at large. We'll speak to the financial part of that and what's going on in the investment markets. And I want to share with you some parallels, again, to what we went through 25, 26 years ago and what we'll call the lost decade that started off very similarly with a very, very significant situation in the Middle East, right? A decade from 2000 to 2010 started off with the attack of 9/11 in New York City and other parts of the United States, and led to over 130,000 troops going into the Middle East with a March of 2003 invasion of Iraq, and well north of at least 4,000 American troops that were killed that we know of. During this period of time, we obviously went through uncertainty in the Middle East. We also had a great financial crisis in 2008, and this led to one of the only 10-year periods in our country's history where the stock market performance was negative for an entire decade. So let's talk about that, as we're seeing a lot of parallels with high stock market valuations, high concentration in the indexes, and also high ownership of U.S. equities by Americans. So let's examine that. 4 charts. The very first one I want to share with you is a correlation between the percentage of Americans that own stocks and the subsequent 10-year rate of return on the S&P 500. In the chart you're looking at, as that red line goes lower, that's actually a higher percentage of Americans that own stocks. And that blue line that follows, that does take 10 years to materialize because that's the next 10-year rate of return. You can see the consistency over time, most recently in 2000, when equity allocations got really high for Americans and the forward 10-year rates of return got very low. Previously, it wasn't seen until the 60s and the 70s. We're now at a new all-time high in allocation to U.S. stocks. So what does that build up for as we look forward? Let's talk about what that looked like the last time we saw this in 2000. And what happened with the market over that period of time, and what do we do if we're going into a similar period of time right now that I think investors are worried about. The next chart that you're now looking at is that period of time, 2000 to 2010, that I referenced. The stock market had a negative return for a decade. If you had $1 million in the S&P 500 at the beginning, you had $900,000 a decade later. And what you're seeing in the yellow and the red and the gray lines on this chart, most importantly, the red line is an equally weighted S&P 500. Same 500 companies, but instead of taking on the concentration risk that the market had then and has now, we had the same amount of money in each business, same group of companies, but your $1 million grew to $1.6 million instead of a decline, just by being evenly weighted and allocated across the portfolio. Third chart, dividend paying stocks. And this is where I sound like a broken record. Anybody knows me knows I love dividend paying stocks. We invest so much time and energy and resources into finding great fits here. And same decade, 2000 to 2010, the dividend aristocrats produced an 87% total rate of return. So your $1 million grew to 1.87 million at the end of that decade. So you had more than double the rate of return of the market index of the S&P 500. Last, 4th chart, bonds, very boring asset class, but the aggregate bond index, same decade, 84% total rate of return. So 4 charts, 4 minutes. We don't think we're going into another lost decade. This is not the first conflict in the Middle East that we've navigated through, and it probably won't be our last. But we want to remind investors to keep a long-term focus as we go through this. Short-term outlooks are murkier now than they were just a few months ago. Our optimism around the long term is still there. However, should we be in a market environment that is what we saw in the 2000s, we're going to continue to encourage people to lean on dividend-paying stocks, have an evenly weighted portfolio, actively rebalance, and put in place where you're comfortable today allocations to select private market assets too that are also holding up really well amidst this market turmoil. So with that said, I hope you have a great weekend. Thank you so much for your trust, your confidence, and your advocacy in us. We're going to continue to do all we can to make a difference and make an impact for you through whatever the world brings us on the road ahead. Have a great weekend.